in 1637? A single tulip bulb sold for 10 times the annual salary of a skilled craftsman. People sold their houses to buy flowers. And 3 months later, those same bulbs were worthless. Sound familiar? Every generation thinks it's discovered something new. Tulips in the 1600s. Radio stocks in the 20s. .coms in the 90s. Crypto and meme stocks today. The names change. The behavior doesn't. So today, I want to give you the single distinction that's protected the world's greatest investors from every bubble, every crash, every disaster, for almost a century. By the end of this video, you'll know exactly which side of the line you're standing on. And the third example I'm going to show you is the one most people get completely wrong. In 1949, Benjamin Graham published The Intelligent Investor, a book Warren Buffett still calls the best investment book ever written. And in Chapter 1, Graham drew a line in the sand. He said this, and I want you to read it twice. An investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. 3 things: thorough analysis, safety of principal, a satisfactory return. Miss any one of them, and you're speculating, not investing. And here's what most people don't realize: there's nothing inherently wrong with speculating. Graham said so himself. The danger is when people think they're investing, but they're really gambling. Because you can't manage a risk you don't see. But here's where it gets really interesting. Let me show you what speculation looks like in real money. February 11, 2000. A company called Pets.com goes public at $11 a share. Wall Street loved it. The Super Bowl ad with the sock puppet, everyone remembered it. The stock briefly hit $14. 9 months later, the company was bankrupt. The stock was worthless. Investors lost roughly $300 million. Here's the question that matters. Did anyone buying Pets.com do thorough analysis of the cash flows? Was there safety of principal? Was there a reasonable path to a satisfactory return? No. No. And no. They were speculating. And it isn't just .com's January 2021. GameStop, a struggling video game retailer. The stock goes from $20 to $483 in 3 weeks. Fortunes made. Fortunes lost. By late February, it was back near 40. Same pattern in crypto. Bitcoin hit $69,000 in November 2021. 1 year later, $15,500. Down 77% in 12 months. Now look, I'm not saying these things can't make money. They can. Some people walk away rich. But when you buy something only because you hope someone else will pay more for it tomorrow, that's not investing. That's what economists call the greater fool theory. And eventually, you run out of fools. 1988. Coca-Cola is trading around $5 a share, split adjusted. Most of Wall Street thinks the company's best days are behind it. Buffett does something different. He reads the annual reports. He studies the brand. He calculates how much cash the business throws off, year after year. He looks at competition, at pricing power, at the moat. Then he buys $1,024 million worth of Coca-Cola stock. That was thorough analysis. The brand was a fortress that was safety of principal. And the cash flows were predictable for decades, that was the satisfactory return. 3 boxes checked. Today, that same stake is worth over $24 billion. Plus he's collected billions in dividends along the way. That's investing. Not a stock tip. Not a hot trade. A business he understood, bought at a fair price, and held while it compounded for 38 years. And notice what Buffett didn't do. He didn't buy because the chart looked good. He didn't buy because everyone else was excited. He didn't buy because he hoped to flip it next quarter. He bought because the numbers told him the price was less than the value. That's the whole game. So how do you know if you're investing or speculating? Here's the test. Before you buy anything, ask yourself one question. If the stock market closed for 10 years tomorrow, would I still be happy owning this? That's it. That's the whole test. Because if your answer depends on someone else paying you more next month, you're speculating. You need an audience. You need a buyer. You need momentum. But if you'd happily own a piece of this business for a decade, collecting earnings, watching dividends grow, seeing the moat deepen, that's an investment. Buffett said it best. He said, "Investing is most intelligent when it is most businesslike." If you wouldn't buy the whole company at this price, don't buy a single share. And remember, this is educational content, not financial advice. Always do your own research before you commit a single dollar. Here's what I want you to remember. Speculation asks one question: will someone pay more tomorrow? Investing asks a different question: will this business be worth more in 10 years? One is a guess about psychology. The other is a calculation about economics. And over a lifetime, only one of them builds real wealth. The tulip buyers learned this in 1637. The Pets.com buyers learned it in 2000. The GameStop traders learned it in 2021. The lesson keeps getting taught. The price keeps getting paid. So tell me in the comments, what's the most speculative thing you've ever bought? And what did it teach you? I read every comment, and the best stories become topics for future videos. If this helped reframe how you think about money, hit subscribe. Tomorrow, we're looking at something a lot of people get wrong: Warren Buffett's biggest mistakes, and what they reveal about his actual decision-making. Until then, stay patient. Stay disciplined. And remember, price is what you pay. Value is what you get.